Hey everyone, welcome to another Visor Weekly call. I'm super excited to have this. Personally, I'm interested in this topic, and I hope the rest of you are as well. Before we dive into it, just some housekeeping as usual. This is a conversation. Please ask questions. Please unmute yourself and write in the chat. This is not a presentation. We're just having an open conversation with Amber, and hopefully you all will also have some questions to add to the conversation. And we are recording this, so if you have to hop off early, don't worry, we'll share the recording afterwards. And for those who are listening to the recording of this, it's always great for people to be live and ask questions. It changes the whole dynamic, and you get sort of like a direct access to the guests we have in us. That's it. So without further ado, Amber, I'm going to give sort of like a short reason why I wanted this. So, first of all, I'm Israeli and I moved to the US a couple of years ago for Visor, but I'm also an American and the whole insurance medical aspects of the US is very unique, if I'm politically correct. And you need a lot of reading AIs to help and people to help you navigate through the complexities around it. Now, it's really easy when you have a W-2 and your employer is covering your health care because then you just go to a doctor and you show them your health insurance card. But then what happens when you don't? What happens when you sold a company or when you retired early because you made enough and you don't have an employer? I've heard sometimes people have, their spouses are the ones that are employed and then they get coverage through their spouse. So there's a whole dynamic around health insurance, which I was a total foreigner too, and I'm still trying to understand. But I've also heard people that grew up here that are also, clueless to it because they've
Mhm.
always been W-2 employees. And so and because of our audience, we talk about investing and many of us are either self-employed or we've exited and we're managing our investments or wealth and we're looking, all right, we still have to take care of insurance. Some people don't believe in insurance. There's a whole dynamic around insurance. And so I thought it'd be really interesting
Absolutely.
to bring someone who sort of like does this for a living to shed some light and help answer some questions and um, and just so we can be smarter, not just about investing, but also about making sure we're taking care of ourselves and all that. So I'd love to hand it over for you if you can give us like short background about yourself
Sure.
and then let's just dive into the conversation around it.
Absolutely. So I'm Amber Flanagan. I own Ashcon Financial, where we're an insurance agency that specializes in employee benefits and then business succession planning. And so three-quarters of my clients have employee benefits of some sort. I started doing employee benefits probably 10 years ago, and really when COVID hit, we had to start figuring out the next version, especially after you're no longer a W-2. And we had to do that because so many people said, I'm no longer going back to work. I'm going to work for myself. I'm going to build my own empire. I'm going to do things like that. And so it's been about 6 years of really working in this environment where most are tiny business owners or are early retirees, things like that, um, in general. Also, the little bit of education background, I am a certified financial planner. So when I talk about insurance, oftentimes I'm talking about the cash flow inside the policy, what you are at risk for, and what risk you have offloaded to the insurance company. It is less about the benefit or the little minute detail, and it is more about the larger, where is your risk lie and what are you offloading to somebody else, right? So you'll never hear me say there's a best insurance plan. There's the one that fits best in your plan. And there's also very few bad insurance products. There's a whole lot of misunderstanding on how they work and how they should be applied. And so if we can get through both of those barriers, then we find products that work for your specific situation.
And we talked about this on sort of the prep call we did for this, and I kind of it really resonated with me the fact that at the end of the day, if we're talking about investments or we're talking about insurance, we're talking about anything in life, it's all about mitigating a risk, right?
Mhm.
Like we're investing and we're taking a risk, we want some sort of return on that risk. We're paying money to health insurance to lower the risk that if something happens to me, God forbid, or if I need to see some sort of medical, get this more than just seeing, my primary care doc physician.
Mhm.
then I got that covered. And so there's no right or wrong. It's all about what is our risk appetite,
Yes.
right? And what are we willing to pay to cover that risk, right? And obviously all of us have different risk appetites, and so it's a dynamic conversation around that. How do
I think
you?
Amber's bringing up a good point though, where thinking about it of what risk are you taking on versus what are you paying to offload to somebody else? I don't
Mhm.
think people often think of insurance that way. And I think that's exactly how this group should think about it. I think what a lot of people focus on is like, what's my copay? What's the
Right.
prescription that cost me? That kind of thing, which that's what we see day in and day out. But really, that's not what the whole focus of this is. That's
Mm-mm.
not going to make the difference on whether or not you really screwed something up and you really negatively impacted your life because you made a bad decision on something. So I think, Amber, the way you're describing it is great for us as investors to hear about it, because I don't think most Americans think of it that way.
No, and regularly I get the what is the best plan? Well, how do you use health insurance, right? Like before we even start, are you I do my primary care, maybe I do my colonoscopy and things like that, but other than that, I'm going to go see my holistic guy and he's not going to take insurance anyway, right? Then why do you want to pay for no deductible and the lowest copay when those aren't services that you are going to participate in? Right? Those are the things that we start to look and say, what services do you want to participate in? What don't you? And how can we find the premium and plan that fits that best?
So I went down this rabbit hole on my own at one point because I was talking about risk. Like I was thinking, all right, I want to do I want to take some time to see how this plays out if I don't have insurance.
Hmm.
And I went out to look for education insurance, like emergency type insurance, which covers the critical illnesses, the accidents, and those types of stuff, God forbid. But all the ongoing stuff you just pay out of pocket.
Right.
Because I was under the assumption that if you're looking at insurance, you're going to pay, and you correct me if I'm wrong, anywhere between $1,500 to $3,000 a month of a family of five, let's just say. And
Good
you know,
ballpark.
so ballpark, and it's like, well, if I just pay everything out of pocket, am I going to reach that? And I can say for a year in, I have never reached more than $1,000 a month
Right.
average. But you always want that peace of mind to know, well, if something, God forbid, happens, that I have the coverage, and then is that other insurance plan worth it? And so that's kind of a conversation, at least from my standpoint. And again, I am a risk taker. I'm, obviously, so it's not for everyone. But like, how would you approach something like that, generally speaking? Or if there's another framework or methodology that you use when you talk with people that are interested in insurance?
So in there, I always look at a bad year, right? You say that regularly you don't spend more than $1,000 a month on healthcare costs for a family of five. Well, I had my gallbladder out emergently last year, and that was a $110,000 surgery, right? So that is what the insurance should be there for, not necessarily the day-to-day things, right? If that's a risk you're willing to take and you have that um if you have that bandwidth to be able to do, because there are those that don't, right? And that's why they actually choose a larger premium and a larger plan is because then they're forced to pay that so that they understand exactly what their costs are, right? That's the other side of it is when you buy a larger plan, when you buy one with more full benefits where you know exactly what your cost is going to be, those are the ones that don't necessarily have that cash flow cushion to say, what happens if I need a $2,500 scan? What happens if I need a $7,000 procedure? You know, those types of things. Um, when we look at catastrophic plans, you got to read the fine print because a lot of those catastrophic plans will have an out-of-pocket maximum for the insurance company. So they may only pay the first $500,000, which sounds fantastic, except for a kidney transplant is $1 million.
Yeah. So you're talking about the
So
caps.
those are the ones that have like a $12,000 or $20,000 deductible. You may hit a $500,000 lifetime cap then on
Yeah.
that insurance.
Yeah.
Yeah, that's
And
something that's very concerning.
lifetime caps are scary. It is most of what the ACA did a very good job of taking away most lifetime caps. But in cost shares and in some of the more non-traditional forms of insurance that are out there, lifetime caps happen. They
Okay.
So
Because
still do
that's not
happen.
really insurance, right?
It is though. You are still offloading a risk to someone else for a portion of it. Did you
Okay.
fully fund it? Not potentially, but you did offload a specific risk, the first 500,000.
so let's go back sort of to the basics here, right? So usually
Sure.
you're a W-2 employee, you have insurance covered by your employer, but if you're the employer, it doesn't matter, but you have insurance covered,
Yep.
and then it stops.
And then it
What are
stops.
your options?
Sure. So you have a few options, right? First, directly after it stops, directly after that W-2 event stops, you're going to have COBRA. And COBRA, the misnomer on COBRA is that it's super expensive. It's not super expensive. It's just full price. You no longer have your employer paying for a portion or all of it. And so they're actually only by law allowed to increase the price by 2% for administrative costs. So it's really just full price. Now that can go for 18 to 36 months, depending on where you are in the country and what your situation is. And oftentimes that's a great option because then while everything else is in transition, your health insurance isn't. You know exactly what it's going to be doing. You know exactly who those doctors are, things of that nature. And especially if you had a high deductible event year, you've had a few costs, things like that, you get to keep that deductible until your plan would renew. So sometimes it's just strategically nice to stay there. But after COBRA, you always have the opportunity to go on your state insurance plans, the ACA, the Obamacare plans, right? As soon as you lose insurance involuntarily, which is COBRA ends, you quit your job, things like that, you can hop on these plans. There's no medical questions asked. And depending on how your accountant arranges your income, you may or may not qualify for a subsidy because that is income based, not asset based. So there is that side of it to say what do those plans look like? What do those plans cost, right? They are
And
state mandated. They only cover your in-state doctors, whatever state that may be. They're going to have a variety of, they're going to have all the different levels, right? Anything from a really high deductible plan all the way up to no deductible and awesome copays. But oftentimes what I hear is that they have a limited network. It, especially on the East Coast, I hear more of a complaint on the East Coast than I do the West Coast. But that their state plans, no doctors take it, and there's no out-of-network benefits, right? But is it always available? Yes. Up until the time that you're age 65, it is available. At 65, if you are not working for a company, if you are not a W-2 worker, you go to Medicare at that point, right? Uh,
Amber,
Go ahead.
with the so like for me, for example, like I'm primarily an investor. I have a couple of businesses that make a little bit of money, but I'm mostly investing. But I also then usually get enough deals with depreciation that there's some years where on paper I don't make any money. The next year, if I don't do a depreciation deal, it looks like I make a little bit of money.
Yep.
How do those work that way if I legitimately don't know at the end of 26 whether it's going to show that I made 100 grand or it's going to say I lost 80 grand,
Right.
and either of those are possible. What would you recommend for people? What have you seen? How do the states go after you if you erred on the wrong side of
So,
that?
yeah, if you erred on the side of undeclared income, they're just going to charge you back premium.
Okay.
If you err on the side of you expected to make too much money, they're not going to give you a refund.
Okay.
So, that is typically how the states handle that. And it is something that you have to declare and project every year. If you know mid-year that things are going to change, you are allowed to update your state. Um,
Yeah. Okay. The other
so
thing I've heard from people is that if you declare, like for example, I had a few years recently where I had no income. Like my federal tax return showed that I lost money because I had massive depreciation from hopefully great investment deals.
mhm,
Well, what I've heard is that if you turn that in, then they'll try to put you on like a Medicaid type thing. And I've heard from some people they don't want to be on that. And so you actually have to, even if you think you're not going to have any income, you have to say you have enough so you don't end up on
yep.
Medicaid, but not too much. So then you end up on the like your proper amount of thing on the state. Like, what have you helped people do that way? Because I could see a
So,
number of people on this call or listening to the call later that are in a similar boat where as
right.
investors with rep status, we really don't know year to year what it's going to look like on paper.
And I appreciate the what does it going to look like on paper? Do Many do not want to go on Medicaid, and I understand that. You are right, that guidance has been just err on the side of making too much money than in paying for a plan instead of being on Medicaid. That's about as far as I go into the advice on that side because I don't actually facilitate any ACA products. So I know enough to make me dangerous on that side and know that this is exactly how they work and the complaints that I hear. Um, but I don't actually fill out the applications and kind of get people into the right income slot, right?
Okay.
Um,
And not having Medicaid, is it the quality of insurance or is it an ego thing or what? Because the
it's
what
usually
I
access to
have,
doctors.
okay, access to doctors. So
It's usually
Medicaid
access
has
to
even
doctors.
less access to doctors than some of the crappy insurance you can get on a state plan.
Yeah.
Okay.
Yeah, that is usually the biggest driver of that. Yes. So
So
if
what's
go
it,
ahead.
sorry, what's an access deductor? Sorry for an ignorant question. What does that mean?
Access to doctors. So like your doctor won't take it. There's a lot
Oh,
of
access to
insurances,
doctor. I thought you
access
said
doctors.
access.
Yeah.
I thought
So
you said access deductor. Like, what is that? Okay, go
Sorry.
no,
ahead.
no, yeah. So Medicaid pays so little that the
Mhm.
best doctors often refuse to accept
Refuse to take it.
Medicaid patients.
Right.
And they'll
But
do
that
that with some
brings up
insurances too.
it brings up a solid point that in every time you look to change your insurance, your homework needs to be, do my doctors take it? Right? Because just because they take Blue Cross Blue Shield does not mean they take your Blue Cross Blue Shield network. Are you on the Blue Card Access Network through New York City, or are you on the Connect? Because those are two different networks, right? They could take one and not the other. So making sure that you're paying attention to network is as important or maybe even more important because there are doctors that you need and there's doctors that you want, right? And at some point, sometimes it becomes a price versus access conversation. Absolutely. So if we're not on, I did not see the question that popped up.
So Cody has a question. Cody, you want to chime in? And I'm not sure I understood what you wrote here, Yara. What did you mean?
Sure. You were saying that if you declare too little income, then you'll just have to make up the payment.
Mhm.
But if you declare too much income, that you'll have to that you don't get any refund. So it sounds
Correct.
like the strategy is that you always want to say that you make less because then there's no downside. Like,
Correct. There are those that will say, well, I guessed wrong and then I got hit with a $10,000, tax bill because it was really the back pay and the premiums. And they're not ready for that. There is also the liquidity of, whoops, I made a big mistake and they're not ready to pay that bill, right? That's when usually I see people want to even err on the side of a little bit over so that they know they're not going to have to pay anything back. But yes, you are
is
correct.
it a penalty and interest thing, or is it just a cash flow management?
It's cash flow management.
Okay,
Yeah.
so it's not like
Yeah.
IRS.
So for
Yeah.
Cody, for you, I know you well enough for you. Yeah. I mean, and you're in the same spot I am. It's like, do I want to write a $10,000 check? I don't. But I legitimately have no idea. Like I really don't know sometimes until the last thing in the year. It's like, am I going to do that last investment that gives me another 150,000 in depreciation and therefore I'm going to show no income? Or am I not going to do that one deal and then it shows that I just made
Mhm.
120,000? And I I don't know. I really don't know.
Yeah.
What's
Good
up,
question.
Leslie?
Hey, I'm finding that I'm not sure I'm exactly clear on what we're talking about. Are we talking about income qualifiers for ACA individual plans?
Yes.
I guess can you say more about that? I didn't know that there were income qualifiers for
So there's
ACA.
not an there is not an income qualifier, because that's a hard word to say today, to join the plan. It's only if you're going to get a reduction in premium.
Okay.
Yep.
Yeah, and
Yeah.
so Leslie, what it is for myself at least, and for some other people that could maybe be on this call, because I do deals on purpose that have depreciation, there are years where even though I made enough money to live, and like my net worth is going up, on paper, it looks like I lost money. And so I legitimately lost money. And therefore, if I put in that I'm going to lose money, and I knew that, I'd end up on a Medicaid plan because they would say, well, you have no money, so you need to be on the Medicaid. I don't want that to happen. And so what I've done, and I'm brand new to this is only my second year in it because I'm in a post-divorce situation is why I'm experiencing this. But it's something where it's like I'm not sure. And so it's like I've been saying, okay, what's the most I can say I'm going to make and still get what seems like a reasonable subsidy because there's a chance I'm below that, but there's just as good a chance I'm above it.
Yeah. So moving away from ACA, because that's not always everyone's favorite option, it can be a very suitable option, but it's not always everybody's favorite, is that most don't understand that you may actually qualify as a group. So to qualify as a group in most states, you need two people to own an LLC or another entity of some sort, just not a trust. And one of them needs to participate in the insurance. Now, the caveat is they both need to live in the same state or have multiple partners and have a majority in one state, right? So if you and maybe your adult child who no longer lives at your house anymore but lives in the state, both are part owners in an LLC, you're a group. We could look at group insurance. Why is that beneficial? That's beneficial because that opens you up to the largest networks nationwide. It opens you up to more plan design, and it gives your LLC a tax deduction. And everybody likes that. So there are times when it is more about how can we be creative in making sure that you qualify as a group and what would then you have access to more than how functioning is that LLC, right? Because nobody's asking for profit and loss statements. They ask for K1s every year to make sure that you are still a legit entity, but they don't care if you're showing $10. They don't.
Amber, do you have to pay a lot more? What I've seen in the past when I've worked for large companies, medium-sized companies, and then my ex-wife worked for a very small company, is that these small companies, maybe that had 50 to 70 people in it, their fees were way higher than a company that has 10,000 employees. If you have one person,
You're
two
right.
people,
And so
what does that look like as far as paying
there's a
price?
perspective shift there though. If you are going to pay full price on the ACA market, a small group plan is going to be reasonably the same price with a larger network and better and probably more full benefits.
Okay. So
So
this is where we're
yes, does
not
a
going to get a
10,000 group,
subsidy.
yeah, this is where the group of 10,000, yes, are going to have a better rate than a group of one, 100%. But we're not talking about comparing 10,000 to one, we're comparing one to one,
Okay. So
right?
this is for that person that knows that they're going to make enough that they're not going to get a subsidy on the ACA and wants
Yep,
better insurance.
yep.
So for about the same cost, you can open up more opportunities.
Or not even that they know that they're going to get a subsidy or not, but they want to have better access and nationwide access.
Yeah.
Mhm.
And nationwide access would be great. I'm hoping to be kind of a dual household person at some point in time. And I didn't realize it, but yeah, when I was in Washington, I had one set of insurance and that was it.
Yep.
Those aren't even available in Arizona where I live now. And it's like, so if I go to Colorado or Washington, I have no insurance.
It's not that you have no insurance, because as long as you have an ACA compliant plan, which any of the fully insured plans are going to be, but you do need to
Okay.
make sure that it's ACA qualified. If you are in a true emergency, your very closest emergency room is covered as a network
Okay.
nationwide. Right? Now, that does not mean that if you have the flu and you need some fluids, that the emergency room is going to be covered. There is a gray area in most insurance companies calling it a true emergency. But that's why when you're in a car accident, they don't ask you which hospital you want to go to. They're going to the closest one because it's a true emergency. Yeah.
But like your surgery that you had last year,
Mhm.
if you had been in Wyoming vacationing when you needed that and you went to the hospital
Right.
in pain, you had to have a surgery, that
It would have been
110,000
covered.
would have
Yeah.
been covered. Okay,
Yeah,
great.
because it was life-threatening at that point. Yes.
That's the
So
AC, that's under ACA.
that's under
And,
ACA. That's an
and
A.
under the union. but it sounds like the union is
Well,
better
well, the union
in
is the union is
normal thing.
anyway like that, like because that's regular insurance, isn't it?
Yeah,
What is the
they do. Yep, I heard it. What's the union?
yeah.
So
I know nothing about this. I'm leaving in May, so this is my first call on anything here.
gotcha. So with that, so we have the ACA, we have can you qualify as a group, right? And I like to do that one if we can qualify as a group just because of access and things like that. And then so at the same time that the Affordable Care Act was formed and they put in all these rules, they also took away a rule that said that you can't band together for the sole purpose of insurance. What that means is that you and 200 to 300 of your newest, closest friends who all need health insurance can get together and become a group. But one of you needs to know how to facilitate health insurance and administer it. So it's not the law of 200, it's really the law of one, right? That you need to have to figure this out. With that, unions looked around and they said, we already do that. We put together people all the time. And we administer benefits regularly. We can do this. Can we start to create groups that aren't just pipe layers or aren't just, welders or whoever it might be? And that's exactly what they did. They started to define groups to become a larger group so that you could, like Mike said, have a larger group of 8 or 10,000 people and be able to have a better cost of insurance with more flexible benefit options, right? This is not an uncommon practice. Typically, most employers that are above 200 or so employees all do this also. It's called self-insuring. And they do this because when you have a group at work, you typically have a healthier group, and standard rates are based upon the common health of your area. So therefore, you're adding in people who aren't working and disabled and things like that along with your workforce. And so therefore, those premiums tend to be a little bit higher, right? So if we can put together a group of people and we can keep them healthy, we can actually have a much lower cost of insurance. And that's exactly what the unions have done. Now, I am up in the Northeast. I'm in New York City, and most of the unions that I have ran across are a little bit more local based to me. Why is that important? It's important because the health insurance cost is based on the location of the entity. So the costs of New York City are very different than the cost of Oklahoma City, which are different than the cost of Miami or Seattle, right? They're going to be different costs. And so when we're looking at the union plans that I typically represent, they are very, very competitive with a New York City pricing. They're typically competitive with Florida, Texas, California, a few other states, right? Depending on your state and even on your location in that state, it may be different because unfortunately, that's priced down to the zip code, which is nuts, by the way, when you start to think about how many zip codes are in the country. But so with these plans, you get to join a group. And I'm sure that many of you have gone down this road, right? You've looked at a PEO that does exactly the same thing. You put people into a group, but maybe you didn't need the administration. Maybe you didn't need the workman's comp. Maybe you just didn't want the other constructs that were around the PEO. This takes that portion away, right? You get a nationwide network. You get to have, like I said, more flexible options and benefits, anywhere from, a standard bronze plan all the way up to a gold or platinum plan. And the caveat is that in some of these unions, they ask medical questions. And those medical questions can be a barrier of entry into the plan. How can they do this? Well, they are not subsidized or ran by the federal or state government, so they are not required to take everyone in. This is a self-insured plan. They are becoming their own insurance carrier. So at that point, they are allowed to discriminate upon risk who joins the group, right? Not every one of them does, but most of them do at some point. Now, if you join a plan like this and and 6 months later, you develop, I don't know, stage 2 skin cancer, right? Something totally yes, you have to go through the stages, but no, it's not going to be devastating to you as a person in the long run. Um, they're not going to not cover it. They're also not going to kick you out at that point. That's why you have health insurance, right? They just wanted to make sure upon entry that they knew exactly what their risks were in accepting you into their group. Make sense?
Yeah, is it also like the health share programs where they will not cover pre-existing conditions though, or how does it usually
No,
work?
no, it's an all or nothing. Once you're in, and everything is covered,
Okay.
right? They don't put the rider on there that says, well, you've had bad knees for a while, so we're not covering your knees, right? Um, that's not going to happen. But that is also one of the things that, I don't deal personally in cost shares, and I don't do those because there's so many caveats to them. They work very well. And I even have clients, I have employers who have chosen to go the health share route and have fully insured plans for their employees because they find the value in the benefit for their employees, but don't find the value in the cost for themselves. And they're willing to take on that risk. And we've had a risk conversation. Um, so those are out there, but I just don't choose to participate in them because of the very fine print that goes into them like that.
But let's go back to the unions for a second. I have a question because
Sure.
you mentioned PEOs. And is a union essentially a type of PEO without the salary requirement that PEOs have to ensure people under the PEO? Because,
So the way that they access health insurance is the same,
right, but
but
only employers can join PEOs, like an
right,
individual can, or
right.
EORs like they're all under the same employment type aspect.
Yep.
The unions sound
They
like
don't. They don't require that, right?
And what
As
is a
long as you
PEO?
can satisfy the definition of a member, right? So I have ones that are for 1099s. I have ones that are for those that own an entity. I have ones that are for only mental health therapists, right? There are a few like that. So, as long as as long as you fulfill the definition of member, you're fine. You don't
Mike,
have a
yeah, Mike a PEO. Mike Schwager. He has a PEO, Infinity HR. Um,
mm,
there are all these. I mean, I don't know how to classify them, but when you start a company and you want to pay employees and give them benefits, you go to a PEO to administrator
mhm.
that. Um,
Okay.
so yeah,
So
Yeah, it's
you're saying a PEO would be the type of thing that would choose the plan normally versus we're coming in and joining a union plan if they have what we want.
yes. Yes. So the same thing happens in both sides, right? In a self-insured plan, what ends up happening is that they go out, meaning the union or the PEO, they go out and they rent a network. Usually I see Blue Cross Blue Shield's largest network nationwide, the Blue Card Network, right? From there, they work with a third party administrator and an actuary to make sure that their plans and pricing are reasonable. Then the union collects the premiums. And then the union pays the claims. They don't pay Anthem. They have Anthem there as a reference network for you. So you have a network of doctors to go to, and that they have contract pricing in place for negotiated rates, right? So if you go to a specialist, they can only charge $300 an hour, or an EKG can only be $275 or whatever it might be. Whereas if you were paying in cash for that, it could be double or triple that price.
You're really subject to how good the underwriting is that they're doing if they're carrying the asset and liability on the union's books, then, right?
You are, except because yes, there is a significant liability there. They also buy stop loss insurance so that if in any given month or year they have a larger claims event that they can insure themselves, they reinsure, and they can stay fiscally sound.
Interesting.
Yep.
Leslie, you had a question?
Um, Amber, would you speak to a self-employed person moving from one state to another? What are the rules? Because that's a special event.
Mhm.
Uh, and just what are the rules, or what do you think about so you don't have a gap in coverage?
So you have 60 days in that move to be able to sign up for the new state if you're looking at ACA plans, right? If you are self-employed but figure yourself out how to be a group, you don't have to do anything. If you join a union, you don't have to do anything. Some of those cost share plans, there's less you need to do, right? You may need to make sure that they have that same cost share program in that new area, which they may or may not. But if you are on an ACA plan, you have 60 days to change that plan. And you don't, so typically what I suggest people do is get there, then find your new plan with the doctors, get there, be there for 30 days. Yes. Are you really only covered under an emergent situation? Yes. But hopefully in a planned move, we're also planning the other things and we've picked up our medicines and we've done our our checks so that we can then go through that move, right? And then once you've been there for 30 days, then put in your application to change. As soon as your application to change has happened, then cancel. You never cancel insurance first. You always make sure the next one is in place before you cancel so that you don't have that gap in coverage.
What,
Yeah,
what,
Leslie,
what,
the other
what, go ahead.
I was just going to say the other thing that I found is that you can't get the new insurance if you know you're moving to a new state, but you don't have an exact address yet. Until you have an exact address, you can't
Right.
get the new insurance.
No.
And so that's the other thing. So I picked mine relatively quickly, but had a month to where I had to be covered on my old plan
Mhm.
in Washington before I could get to Arizona because since I didn't know where I was, I couldn't sign up until I was
Yeah.
actually here and had an address.
What constitutes day one of the 60 days? Like, what is the trigger? Is it like getting a driver's license or like what is,
Yeah, it's in the day you sign your lease, the day you buy the house, right? The day you actually move there. Um, many times, many states are not super strict on what that actual day looks like. And that is a little bit to do with the fact that they can't retro, and very rarely. I've heard one or two people tell me, well, I called the state and they were able to do it. Okay, cool. But usually you can't backdate. So you need to get there and then you're going to have 2 months to be able to sign up, right? So it's probably going to be 2 months, 2 weeks, 2 months and 3 weeks. Maybe it's, in that general range. I typically tell people once you get settled, please go and pick out your plan within about 2 weeks, 3 weeks, so that you can start to get it moving. And so that if you need urgent care, you can go to the urgent care near you, not wherever home was.
right?
Right. So that's the other side of it is that there's usually a more pressing, let's make sure we're have reasonable access to care if we need it and do that shortly after you show up.
There's also because I'm moving because this is my situation. I'm moving from Georgia to Ohio, and Georgia doesn't allow like in Ohio they do allow a single person business. You can join like the Chamber of Commerce
Oh
through
yeah.
these different. It's a group
Yep.
through a local Chamber of Commerce, and the rates are much better
Yes.
than an individual ACA plan.
Those happened. Those happened at the same time these unions popped up, right? Um, you're banding together it's not the sole purpose of insurance because you are joining the Chamber of Commerce. And the Chamber of Commerce is now, because you are a member here, you also can participate in the health insurance, right? That's how that one works. Yeah. But that's how you become the member. That's how you define your membership to be able to join.
By the way,
Thank you.
the option for forming an LLC, which you touch upon with your son or daughter,
Mhm.
can you also do that with a spouse or spouse
You
or?
cannot, well, if you don't live in the same house with your spouse,
Oh, you have to live
you
in you
can.
have to live. Yeah, I
Yeah,
understand. Yeah.
you're a household if you have the same
Got it.
address,
Okay.
which is why I say adult child who doesn't live with you, mom, dad who doesn't live with you, right? Those things are often viable options to create a group in an LLC if you don't already have a working partner, um, or a partner in there.
But then what's the benefit of forming an LLC with friends or whatever kids that are living out of the house as opposed to joining a union group? Like why?
So the medical questions could be a barrier,
So
right?
it's like
Also,
so if you can't join a union or group, you that's an option, not the other way around.
you know, I also look at it as if you are dabbling in an LLC that may be something that you are growing, I would prefer to put you on a small group plan over a union plan. And I would prefer that because the small group plan I can expand to include employees and can be a little bit more flexible. And you're not asking your employees medical questions to enter the plan because in many of those unions, every single person has to individually qualify to join the union. So you would hate to hire an employee and then find out that they have, I'm going to make something up, type 2 diabetes and the union won't take them,
But when
right?
you, if I'm joining as a family, can I join as a family to the union, or even if I do as a family,
Yeah,
each member of the family needs to go through the same type of questionnaire
they
individually?
all have to go through the questionnaire. Yeah.
Got it.
And many unions also don't cover any specialty drugs. So even if you would qualify on the medical questions, they're not going to cover the drug that is $10,000 a month. And so again, a time when I really like to rely on the small group plans because those are more likely to be able to cover things like that.
Interesting. Thanks. Yeah,
Yeah.
Cody, go ahead.
So it's not like I'm joining and my dependents are automatically enrolled like you have with a corporate life then. That's
Nope.
what you're getting at. Okay, I guess the next question is the other benefit the tax deductibility of premiums if you do it in your own LLC versus if you're going with a union, or does that?
No, because the union you can have your LLC pay for it. So it's actually kind of funny because somebody I had one I had a gentleman ask me last week. He was like, "Well, which LLC do you want?" I said, "I want the one that needs the biggest tax deduction." He's like, "Oh, okay, cool."
Can
Right? It
can an
didn't matter.
LLC also pay for an ACA plan?
The NAC
Premium
plan.
there. The ACA plan. So I've signed up for the state.
So
Can my
yes,
LLC pay for that? Because I've been paying for that individually.
it can. It may not be tax deductible. Anytime that you are receiving a subsidy that is actually a advance on your taxes due, so that is not a tax deductible payment when you are receiving a subsidy. So it can vary on that one. I
It's
will
like,
defer to the
yeah.
accountants though.
But it is like you said at the beginning, and it just enforces my fear of how complex this whole thing is. And it is, there's not the best thing. It's all dependent on the risk, but it does because, even when I was thinking, all right, well, the union is better than the LLC, but you're now saying that, but the LLC, but the union has, leave alone the medical requirements. It has caps on like the
Yeah.
drugs you could take and all that. Whereas and I understand why it makes the most sense to stay employed somewhere. Like, like the W-2 is like the best option. Like there's no better option than the plans are it doesn't sound like
Unless unless you have a high medically complicated or a medically complicated child and your employer only gives you a bronze package option and you're paying $20,000 a year for care, right? So there are definitely times when, just because you're W-2 doesn't mean that your employer picks out suitable plans for you. And that becomes the hard part. And then we look at supplements, right? Then we look at maybe can we add on an indemnity plan or something like that so that we can enrich what you currently have at work.
right.
Yeah.
Okay. Interesting. Yeah, obviously you want good insurance, right? You from
The good
the
is in the eye of the beholder.
well, no, I mean they're poor insurance for employers might offer like Jacob's mentioning might be employers that offer bad insurance, but if you are the employer, let's say you're self-employed and you work with a PO or an EOR, which is like you're not working for the company, you're working for a company
Yep.
that's working for the company, and you just take a small salary from your company and you have a W-2 and then you get the health benefits that come with that, that's also an option, right? Through like
Mhm.
it's like the seventh option that we just talked about, but it's also
Right.
an option. Then you can decide on the best plan that fits.
Yes. PEOs typically, not always, but typically, they need at least two employees, two W-2 employees. And that one of them can be the owner, right? That's usually not a problem. But usually they want at least two. I've seen a few where they've been in the group for so long, they've been at the PEO for so long, they were up to 6 or 7 employees. Right now they're down to themselves where they didn't get kicked out. But in the same fashion that, I have actually two groups that last year came to me because they had such high medical expenses the year before, the PEO kicked them out.
So let me ask
So
you a question.
that can happen.
Let's say you want full coverage for you and your
Yep.
family. You're not as concerned for the premiums. You want the best plan, quote unquote. And you're which of those avenues it suits you best. You don't have medical history, you're fine, but you don't want to hiccup where they're not going to cover you or they won't, you won't be able to take these drugs or whatever. Which is the best structure that you'd recommend for people that are in that mindset?
The most steady structure is going and creating a group as an LLC. It
And then
is.
and then you choose the best insurance for that LLC. I mean, the best that's
Yep.
suitable for you.
Yep.
It won't necessarily be the cheapest option though, it sounds like. It might be one of
No,
the most
it probably,
expensive.
it may be, it may not be the cheapest option, right? The union is often a very nice balance between price and availability, and you don't have to qualify as a group. You don't have to bring on the adult child. You don't have to find a friend. You don't have to do any of that, right? If it's just going to be you and you understand those risks, I probably have 120, maybe 150 individuals on union plans because that made more sense to them than creating a group, going through the work to create the group. But they wanted, they were in a position where they were going to either pay full price for benefits or they needed better access. So they were willing to pay the price to be able to have the access and the more, full benefit. Yeah.
Yeah. Interesting. We didn't talk about health shares, and I know you have. We did a bit, but
Yeah.
I did want to sort of like add some context as well because I still am paying this health share company, and it doesn't have a cap. It doesn't have any
Awesome.
limitation. It does. The downside is you do pay up front. Like if you go and you have to go to the emergency room, for example, and it costs 100,000, you pay the 100,000, and you get reimbursed by the health share plan, which is a downside for sure.
Hmm.
The second, there's um, a period where any pre-existing condition is not covered. Like I think the first year is not covered.
Okay.
Uh, but then I think if you're there long enough and you are just concerned about the emergency situations, which it covers, I have again, I'm just mind blown. Like no, and I guess touch on a word, we're a healthy family, but it's just hard for me to justify paying anything above $1,000 a month when averaging that historically has been
Right.
easy.
No,
Um,
and if you find a solution like that, that's phenomenal. I end up with those that didn't find that solution, and they said they stopped covering my birth control, and they stopped covering this, and they stopped covering that,
yes.
and oh, I hit a cap and I didn't realize there was a cap, or oh, I didn't realize this was an indemnity. I had one gentleman last summer that came to me. He goes, I have 8 policies and I don't even know what they do because each one was like a different critical illness or hospital, and they all capped out at like $25,000 in payment. He goes, how did I get here? So I don't know, but we can get you out. Right?
Yeah.
Like we can figure this out.
Uh,
Um,
Yeah. Jacob also, we didn't talk about it at all in terms of HSAs, but how would play that as part of the
oh,
whole
I
insurance?
love HSAs. HSAs are phenomenal. There are some of the most tax efficient and cash efficient policies that are out there because typically, not every plan, but typically they have a lower out-of-pocket maximum. They're still going to cover all of your preventative before you go into your deductible. So OBGYNs and PCPs and cancer screenings and vaccinations and well visits and even some medicines are going to be covered at 100%. So if that's where you spend most of your time, then now we have yes, you have a risk of X amount of dollars for a catastrophic event, but you've also stopped that loss. You know where your cap is on a catastrophic event. And I define catastrophic as literally like walking into the hospital. But in general, that's where you're at. On top of that, then, so you have a lower premium, you have a lower out-of-pocket maximum than most of the plans that are out there. And then you're also going to have the option to do a deposit into an HSA account for up to $8,600 for a family. And that's a tax deduction too, and a tax deduction that rolls over if you don't use it all. And so then it grows on a tax-free basis. And as long as you use it for health care costs or health related costs, it comes out tax-free. But if you have an HSA account at Fidelity or something like that, you can also start investing it. So now all that growth you get into it can be used for Medicare premiums once you go into retirement. I saw somebody, it was like 3 years ago, somebody in my group, one of my groups bought a Peloton on her HSA account. Like, they're great as long as they are a very, very good risk management system. They really are. You know where your stop loss is, and you have a really good tax advantage to it too. In years where you're making money, Mike. When there's years where you're not making money, you don't need the tax deduction,
Right.
right?
Yeah,
Ton, will you
Cody.
share what health share plan you chose to use?
I use a company called Zion. Um,
Yeah, I've
I
heard of that.
yeah. Um,
Yep.
I am facing an issue with them at the moment, to be honest, because my youngest went to surgery for tonsil removal, and apparently he was in surgery a couple of years ago, and they did something to his tonsils as well, and that flag that he's in the initial period of the anyway. I'm still negotiating with them, but essentially, yeah, I'm overall happy with them. Yeah, Cody, go ahead.
Is this the first time that you've used them?
You mean Zion?
Yeah, yeah.
No, I've used them already, but this is the biggest expense that I'm. Yeah. Again, I paid out of pocket and I want to get it back. That's my
Yeah,
goal.
it's the classic insurance is great until I have to use
But I'll
it.
be honest, the $1,000 a month I'm telling you is including that, right? So
Oh,
like
okay.
I'm still it, it's it's not, I think it was like $10,000. We don't spend a lot on, we don't like, again, touch wood, we're healthy. I mean, obviously if we had ongoing, situations or medical needs, mental type stuff, like we don't have all that stuff. And so I'm assuming
Mhm.
if that adds up, and it probably
Yeah,
would not work in that case.
yeah. I guess the question that I was going to ask was you mentioned the PEOs kicked them out. Like, what do you do after
Yep.
that? You mentioned a scenario where I needed $1 million kidney transplant, I think was the example you used, and they only cover 500,000. Um, yeah, what do you do if you get kicked out? Because now you have a pre-existing condition before you go back in. Like, do you just by default have to go ACA that route? And like, do these
So
SAs
small
do the
group,
thing?
so almost all small group plans are ACA compliant, so therefore pre-existing conditions are no big deal, which is another reason why I tend to lean on small group plans if we can qualify you as a small group,
So
right?
think
So, but
about
in
the
both of those situations, they got kicked out of the PEO because of um, unusual medical costs for the year, in which when we looked back at it, it wasn't, but that's neither here nor there.
Mhm.
It was a risk decision made by the PEO, and they chose not to participate again, right? So with that, they were already a group, right? It was a two-person group at a PEO, so now I just made them a group on a small group plan, and now they're chugging right along. So there's just because one avenue says no doesn't mean all of them are going to say no. And it doesn't mean that we necessarily have to recreate the wheel. We just need to know what all the options are out there so that we can find one that works for you.
So then PEOs, are they also following the self-insure model where they manage?
Yes.
Okay, that's the difference here. All right,
Yep.
if they're
Yep.
self-insuring versus going direct.
Yeah.
All right, and then you were talking about HSA for catastrophe insurance.
Mhm.
Uh, I don't worry about caps in my W-2 stuff, but now that you've mentioned that they only covered to $500,000, I'm like, now I'm wondering about that. Like, are there on HSA? Do you have a cap, or is that?
No, 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 no. ACA plans, anything that's qualified as an ACA, and anything that I touch, I check the lifetime max on, but most fully insured or all fully insured plans do not have a lifetime max. The the health shares, they can sometimes do a max. If you are looking at a non-ACA compliant, they can have a lifetime max. They can.
Right.
But if you're on an ACA plan, they cannot. That's part of the legislation.
Okay, and do these also apply to the people who are doing the self-insured route? Are those typically like
Typically,
fully compliant?
typically they're fully insured, yes.
Okay.
I have not seen a union plan that didn't. I haven't seen them all, so I'm not gonna say there's none out there. But the ones that I've seen, they all do a no lifetime max.
All right, we have time for one more question if anyone has one. If not, we'll wrap it up. Nick.
Hey,
Mike, go ahead. Yeah.
yeah, I was just going to ask about deductibles and how that plays into picking a plan. Like you that you don't use your plan, you can pay for a Cadillac plan, but then you feel like you're burning money because you don't use it. If you can get a cheaper premium by going with higher deductible. And
100%. That's I often what I do is max out of pocket plus premium is going to be your max exposure, right? How much of your max exposure do you want to be a required premium? And how much of it do you want to be at risk if you need a service? Right? And therein lies your risk tolerance and maybe even just your cash flow in general, to be able to pick out the plan that is most suitable for you.
Hey, Amber, is
Yep.
so just to use language, because I know everyone thing is different, but like if you count bronze, silver, gold as general ideas of like low, medium, high, where do you think the sweet spot is for most people if you're not, you could
Silver
pay the
plan.
money if you needed to. That's what I was guessing is usually the middle option is the best one. So silver is the way to go unless you know you're a really high utilizer or a low utilizer, then you would go to one of the others. But
And that's
otherwise,
be
silver is the
and
default.
that's because typically in silver, you're going to have either a copay option or an HSA option. So in there's usually a nice sweet spot that you're not paying an exorbitant amount in premium compared to what you could on a Cadillac plan, on a platinum plan, but you do have a reasonable threshold, say 3,500 for a deductible, those types of things. Yeah.
Right. Okay.
Amber, we're at time here.
Okay.
Anything you want to sum up with before we sign off? I'm going to obviously share all your information afterwards with everyone, but is there anything you want to, sum up with?
No, it's really just always keep in mind that it is about risk management and it is about finding the situation that fits you best. There are so many times people come to me and they say, well, my friend did this, my friend did that. Well, your friend doesn't have the same things that are going on. So at least being able to find somebody to have a fuller conversation with and find the suitable solution is the best way to go. And especially on union plans, you don't have to have a qualifying life event, so you can change direction mid-course, and change from an ACA plan over to a union mid-year if you just realize that that's even an option, right? You're not quite as locked in on that side. So you do have options. You can also start a small group plan in the middle of the year.
Yeah.
So you're not stuck.
Cool. And just to like what we started with, it's like not one size fits all. As Jacob just mentioned, like some people might prefer the gold and pay the premium for that, silver or no.
Yep.
There's no right or wrong. It's all about risk management. I really appreciate you joining, Amber, and thanks for all the insights. Thank you all for joining as well.
Yeah.
I'm going to
Thanks for
share the
having
recording
me.
afterward and be healthy, everyone. All right. Usually I end,
Yes.
invest smart, but be healthy is most important. Have a great
There
rest
you
of
go.
the week.
Have a good one.